how big this market is in terms of employers offering this. Is this mandated? Is this not mandated? Dollars spent on premium, and then just number of employees that are choosing to participate in these plans.
The market space is around 60 billion in premium. The growing voluntary benefit products, it measured in premium, is around 9 to 10 billion. The rising cost of healthcare over the last 20 years in thousands. And then the rising new premium of voluntary benefits, the dollars itself, when you compare a medical plan to a supplemental medical plan, a client that may have 100,000 employer that has 100,000 employees may have a $2 billion, healthcare spend in total, and their voluntary benefits for supplemental health may be 10 to 20 million dollars, but they're all employee dollars. That's the distinction. So
All right, welcome to the next episode of the Scale Community Technology and Innovation Within Healthcare podcast, where I'm joined by Amy Hollis, the founder and CEO of Employees First. Employees First is an innovative company bringing transparency to the voluntary benefits portion of the market. And so, Amy, pleased to have you here and welcome.
thank you for having me. Glad to be here.
So I think we're going to slow down on this podcast and really spend a minute to just dissect the voluntary benefits market before we get into Employees First. I know when I came to this conversation, I was introduced to Amy about a month ago and learned what Employees First was up to. This was a market that I really didn't know much about, and I suspect that's probably similar for a lot of our audience. As I learned more about what the dynamics were that Amy was highlighting and what Employees First is doing, I found it very interesting and relevant to anyone in healthcare, but it was an area that I needed to be educated on first. And so if you'll indulge, Amy, I think let's spend a little bit of time kind of going over the voluntary benefits market, and then we can certainly jump back into what Employees First is doing within this market.
Always the best place to start because everybody does have a different understanding. So it's a great way to get us grounded. Because voluntary benefits, you think about that, healthcare is actually voluntary. They can choose it. So what we're talking about when we speak of voluntary benefits are really more of the emerging plans, and I'm going to get into those, but I'm going to tell you what it's not first. So, you typically think of your supplemental health or supplemental life plans or even supplemental disability as voluntary benefits, and they absolutely are in that category. Even vision or dental plans, many employers have offered that up as employee pay all or voluntary benefits. And those are voluntary benefits, but not the ones that I'm talking about. The ones that we're largely focused on are what have been emerging. I'm going to give a menu, but then I'm going to give a narrow focus of what we're really talking about today. But it includes what I would call supplemental health plans. And that really is in three different product categories, like a critical illness policy that they're in all indemnity-based plans where they pay a lump sum based on a medical event or diagnosis, a hospitalization, getting diagnosed with cancer, you break a leg. It's an indemnity-based lump sum payment of a benefit to the employee. It goes directly to the employee. Those are supplemental health plans like critical illness or accident, not AD&D, but accident, injury, and hospital indemnity. There's others in the menu like legal plans, but that's become even more what I would call more the mainstay, the table stakes for employers, but ID theft, pet insurance, group auto home, there's, even a permanent life with a long-term care rider. Those are all considered the voluntary benefits in the category that really I would put the guardrails around those plans that are just not the traditional benefits that most employers have known for years, and it's been a traditional part of the fabric of their benefits menu. But we're really focusing in on those that are kind of the misbehaviors, the critical illness, accident, and hospital indemnity, and some of the inefficiencies that are baked into those plans that we're trying to address. But that's the spectrum of benefits that we're talking about.
So it's, reminds me of our annual election, because usually when I think of benefits, I think of your traditional medical, dental, and eye care. And then you have this long list of, 8 to 10 pages of coverage. And I guess that's what's included in this. So give us a flavor for how big this market is in terms of employers offering this. Is this mandated? Is this not mandated? Dollars spent on premium? And then just number of employees that are choosing to participate in these plans.
Okay, well, I'll start from the macro. So the space itself, the emerging space, the market space is, I think that there's different sources of data, but around 60 billion in premium. And that's a number of products that are baked into that. The growing voluntary benefit products, it measured in premium, is around 9 to 10 billion. So, that's gone up every year. And I've actually done an analysis where looking at the rising cost of healthcare over the last 20 years in thousands, and then the rising new premium of voluntary benefits. And it's eerie how the trend lines are exactly. There was even a little bit of a dip in 2008 to 10 with the market crash. So they're rising literally concurrently together. The trend lines are matching. So that's the larger scale, but the dollars itself, when you compare a medical plan to a supplemental medical plan, and actually, we've just done that recently. A client that may have 100,000 employer that has 100,000 employees may have a $2 billion healthcare spend in total, and their voluntary benefits for supplemental health may be 10 to 20 million dollars, but they're all employee dollars. That's the distinction. So
it's 100% covered by employee.
For the most part. There are some employers that are offering an employer paid option, but that's the minority. The majority is employee paid. Voluntary and option group buying power on the benefit menu, as you talked about, like right after medical, you'll see the option to enroll in these plans during open enrollment or qualified life events, or for new hires. So that is the size from the employer standpoint as far as dollar premium. Comparing, everybody knows what the average amount is for employee, but you'll see for employees that are buying these policies, the policy range cost is anywhere from, it could be from 100 to, or even lower, 80 to 600, but it's typically around the $200 to $300 annual cost range. It varies by their ages, it varies by what they're buying and the designs, but so that's why the range is so wide.
So it's interesting because it's a decent sized market, 60 billion, although you've narrowed it down to the 10 billion that you're focused on. It sounds like it's growing, and it's a big dollar spend from an employee perspective, but it's actually a relatively small dollar spend from an employer perspective.
Small or nothing for the employers. And even with the employees, depending on what the employee contribution is to the medical plan, it's actually, usually smaller than that amount. Again, every employer is different, but you do have to be thoughtful of the wallet bandwidth when offering these benefits to ensure that, it's an appropriate spend for the employees to add to their benefit menu. And it's a way for them to speak to what the plans actually do and why employers are offering it. And most employers do these days. That's not the case as of 10, 15 years ago, but today it's largely due to ACA and the rising cost of healthcare and the need for employers to push more of that cost to employees. They're offering these plans almost as a soft landing. So I go to the hospital and I have a high deductible plan. I get a hospital indemnity plan that'll fund $1,000 of that admission. So that's a soft landing for these higher deductible plans. Or I get diagnosed with cancer and I have a lot of medical bills and some things that may not be covered. I've got this, $10,000 check for inside of medical and non-medical expenses as well. So that's the reason that employers have been really moving towards offering these plans, is because as they have been raising the out-of-pocket exposure of the employees, they're wanting to give them an option to, in part, ensure their out-of-pocket spend. It doesn't completely do that, but it gives them the opportunity to get a check directly to pay for some of the out-of-pocket expenses.
So do you have a sense for what percentage of employees are taking advantage and opting into these plans?
That ranges widely, as you can well imagine, but you could see anywhere from as low as 2 to 3% of the population up to 35% of the population. It depends on how the plans are being communicated and offered. Oftentimes when they're put on a benefit menu, right after medical, there's something magically that happens in the employee's mind. They put it together. You could send out 100 different leaflets explaining what these plans are, but just the placement of the plan right after medical encourages higher adoption of the plan, because they understand, I can get in this high deductible plan because I can buy this supplemental health plan that may cover some of the out-of-pocket expenditures if I have them.
And any thoughts on the drivers of that sort of wide range of 2 to 3% all the way up to 35%? Is it based on demographics, socioeconomic? Is it based on just the quality of the the primary healthcare plan? Is it based on just the sequencing of how the benefit selections are laid out and the menu offered to the employees?
I would actually say the last thing that you mentioned is probably the biggest driver. So sometimes employers can offer these and it's not baked into their overarching benefits menu for open
Mhm.
enrollment. Like it's not on their, their system of record, like the enrollment system. And that's where you'll see really low percentage points. When it is included into the benefits menu, you'll see the much higher percentage points, but even the placement of the plan closer to medical increases the percentage of the employees adopting the plan. But the communications drive that, the wallet share, the expense of it, and how, what are the demographics of the population related to their expendable income. It's not so much anymore. People used to think that this was very demographically focused, and they're not.
Mhm.
We've seen that since the enrollment venues have basically broadened and have become a part of the fabric of employers' benefit menus. You see people that are of all ages and all demographics, pay ranges. And because a lot of these things are more emotional, they know somebody that had cancer, they saw what happened, so they make a purchase. And then, of course, the risk preference of the employees. But we're not really seeing a lot of the buying patterns around a demographic type. It's around how the benefit is offered and how it's communicated and how it's positioned, and then what the wallet share that would be required to buy the plan.
So the buying process, for lack of a better word, sounds a bit haphazard. When from the employer perspective, they're not really paying for this, so I imagine the amount of thought they put into this is probably a lot less than their traditional medical benefits plan in terms of how much analysis goes into it. And then from the employee side, if the number one sort of driver or variable here is where it sits in the election paperwork, there that doesn't sound like the most thoughtful approach to the buying process either.
Well, I would agree
Let
with that. Go ahead, make your point.
Let's talk about from the utilization side. So anywhere from 2 to 3% all the way up to 35% of employees are buying it. How many of those subset of employees that are buying the plans are actually using the plans?
Plan. That has a wide range as well, and that's based on even like the carrier and how easy it is to file a claim, how it's being communicated. There are things that are going on in the industry that are really great, like integrating whenever you have a medical plan that may actually be a trigger for the supplemental medical plan claim. There's mechanisms in place to trigger or to nudge or to communicate to the employee, hey, you just had a X-ray on a broken leg. That may be a supplemental medical claim as well. That's absolutely driving up utilization. But that is, I would say, the biggest problem in this industry is that the employees are buying these policies and they aren't using them nearly as much as they should or could. The utilization has been extremely low, and I'm going to put it in terms of loss ratios. And that means that, it's not necessarily the number of claims, but of every dollar, for ACA, it's required that there's 85%. The loss ratios on these plans have historically been extremely low. And I thought, as a career-long consultant, they had been creeping up over the years with ACA and more adoption of it. But I've been surprised to see that the loss ratios are still some in the tens and the 20s. So for every dollar, the loss ratio we're still seeing in the tens and the 20s. They are getting higher, but they're being reported higher than they actually are as well. We found that as well with our model, that some of the
Yeah.
carriers are reporting a higher loss ratio than is actually.
We're going to jump in a second to some of the inefficiencies in the market, and then how Employees First is helping to solve for those inefficiencies and bring transparency to this market. But sort of a big picture question: is this the right product? So it sounds well intentioned, right? You've got your core medical benefits, and I think about other countries that have sort of a similar setup, in that they might have baseline government covered plans and then the ability to true up through the private market. This sounds like a version of that. Do we have the right concept with voluntary benefits, or is there a better product that we should be thinking about to cover this gap for people who don't want to be exposed to outsized financial risk for their medical care? We were just doing a podcast last week, and one of the comments from this was a news coverage individual, someone who covers the healthcare market, and his point was that people are being financially ruined from healthcare services. And so from the patient burden perspective, there really is a need in the market for some supplemental coverage or some sort of barrier from this outsized risk. But do we have the right product?
We have the right structure of the product, and the product is good. That's the issue. It's the ecosystem that is not allowing the product to be fully realized, if that makes sense.
Mhm.
That's my perspective. So, and I will say that the product has greatly evolved. I'll give an example. Critical illness. I remember, it's typically cancer, heart attack, stroke. Those are the big diagnosis areas. But then the carriers actually started to expand the menu of diagnosis. But to things like, I don't know, cholera, which has been basically eradicated, or diphtheria. So it looked like the menu was being expanded when it really wasn't. That's
Right.
bad, right?
Mhm.
But I have seen definitely an increase in the number of diagnosis categories that are relevant, like MRSA or sepsis or some of the things. And we're driving that. The employers are driving that. Again, how often do these things happen so the employees would actually need the policy? That is what we've needed to shore up to make the product better, to have a better fit with what's happening in real life and how often they're getting medical services or events that require them using out-of-pocket dollars, which is what these plans are for. So it's improving, and the plans actually are a good fit for these types of some catastrophic, some not so catastrophic events that just, because some people don't even have $1,000, for a deductible. So the product is good. I think the ecosystem and the delivery and the objectives of these policies and these plans are the space we need to examine and really closely look at.
Who's offering? I mean, on the provider side, we know insurers to be the Aetnas, the Cignas, United Healthcares of the world. Are those the carriers for voluntary benefits, or are we dealing with a different set of carriers?
Well, they are now, but that's been an evolution. So everybody in this space, the carriers, the employers, the consulting firms and brokers, they're all going after this space because there's been so much money in it. So
Mhm.
it used to be that, it was the non-traditional carriers that had these plans like a Transamerica. They're not really in the healthcare space. Unum, they're the life and disability, but they also had, so the non-traditional carriers, but then it moved into the life and disability carriers, and
Mhm.
now it's medical. So, all the big medical plan carriers, most of them have these plans. They have filed for them and they actually have them as a part of their offering.
And a lot of money in the space is driven by the lack of utilization of the plans. A lot, 35% of people buying with very few people actually calling on the insurance.
I would say two reasons. What you just mentioned is one, but two is the lack of transparency into these plans. So you can't make something better if you don't see what's actually happening.
So let's get into that. So walk us behind the scenes, and now we'll talk about the ecosystem that you've alluded to a few times. Walk us through that ecosystem, and feel free along the way to point out the inefficiencies that you see.
Well, so I'll start with relaying that, I think some people know this, some people don't, but these plans are accepted, from an ACA perspective, just like dental and vision and some of the laundry list of accepted benefit plans that are medical payments, but they aren't required to adhere to ACA requirements of the plan. But the problem is that this is the only one that is required in that language to be fully insured. It is my belief, strong belief, that has been a part of the veil that has kept the employers from being able to see what's actually really happening, and they're having to count on the carriers or their consultants to understand that. That's number one. The other part of it is employers really should be focusing on their medical plan. I mean, when you're seeing 8%, 12% trends, you don't have a choice. They should be focusing on medical, and they are really relying on their consultants or brokers in order to vet and manage these plans and products. My perspective, and that's the space that I came from. I was I'm a 20-year plus consultant in that space. I came from the healthcare side, but moved into voluntary benefits early 2000s. And so even the consulting firms had to hire practices to focus organizational intelligence in these space because it's not relatively known. It is a complex industry, and you have to live in it and wrestle with it to really understand how the space works. And so a part of it is the veil of the fully insured product, which ACA requires for supplemental health plans. But then it's the complexity of the product and what's happening behind the scenes that truly the employers don't have the bandwidth to focus and learn about, but they should, because they can be more of an integrated part of their strategy. And they're relying primarily on their brokers and their consultants, but the broker and consultant, the audience, the relationships is really between the carrier and the consulting firm, because the carrier is the one that's paying the consultant, not the employer. they're paying in the form of commissions. So you've got a disparity and you've got a misalignment of incentives from my chair, and that's the ecosystem that I'm talking about. So first you have a product that is wrought with dollars and margin because you've got premiums and you had low utilization, and
Mm-hmm.
the rest of it is in profit margin, and the ecosystem has been living off of that for, I mean, that's been a pretty dramatic revenue source for even benefits administration platforms. Everybody is in on that.
Mm-hmm.
And so you don't have an industry that's actually going to self-correct. Increasing the value of the plans. First of all, the employer doesn't know it necessarily per se, so they don't see it. They aren't paying as much attention because they're counting on their consultants and their brokers to
Mm-hmm.
do that for them. And then you have, the dollars that are basically subsidizing a lot of different, revenue streams. And so that has created this mix that frankly has gotten worse and worse, even as I left Towers as a practice leader. The drive for these plans to have higher and higher compensation is coming from the consulting community. And so the carriers can't, even if they wanted to, raise
Mm-hmm.
the plan value by putting more meaningful benefits added or richer benefits to be paid, go out and paid claims. They're being blocked from doing that because they have to make money too
Right.
at the same time. So, it's been an
You mentioned a few times about being fully insured, the requirement for these plans to be fully insured, and that has a cascading implications. Can you just clarify for those that are less familiar why that fully insured requirement creates the implications that you're referring to?
Well, and I think most of your listeners would understand with Kaiser, that's a fully insured product. So it's more difficult to understand if you're self-funded. You see every claim, you see where all the dollars go. You have control over the expenses,
Mm-hmm.
or over an ASO or over, whatever the point solutions are. You see, for the most part, I know that some things in bundling in healthcare, I'm simplifying that, but you have more control and more visibility as to where the dollars are going and what the expenses are, and be able to measure, is that expense worth the price tag that we're paying for it? You don't have that ability in a fully insured program because everything is lumped into a single premium. It's like paying your auto insurance. You write a check, you don't know where those dollars go necessarily. And you don't get necessarily the cleanest of claims reports. The reporting on the actual claims have not been accurate. And I've seen that directly as a consultant. I didn't have access. It was difficult to get that claim information from the carrier. And that's true as a whole for a fully insured product. Their profit margins are based on lower loss ratios. It's just that's the
So
way it
fully
works.
insured meaning you're relying on the carrier for the underwriting rather than a self-insured plan where the
Exactly.
employer understood. Understood.
Yeah, they have
That
to.
makes sense. So it's just another reason why the employers are a step removed from the details and the aligned interests in this plan versus medical, where they're in the loop for a whole host of reasons.
See
They've got to
all.
share the expense, and a lot of times they're underwriting some or all of the risk from a carrier, an underwriting perspective.
They're paying the claims for the most part. Most employers are, a certain size are not fully in. Major medical way back when was fully insured plans. That's why ERISA came into place, is to govern self-funded plans, whereas the states would govern fully insured plans. So that governance went away, and that's why ERISA came into being 50 years ago.
You mentioned that some of the medical insurance carriers, the Aetnas, Cignas, Uniteds, Blues, are moving into the voluntary benefits
Oh, yes.
space. Is there a sort of a conflict between offering the medical benefits and the voluntary benefits, or they don't really relate to each other? What I'm getting at is I would think on the core medical benefits, you might have an incentive to sort of constrict what you're underwriting and insuring and then leave it to the supplemental benefits if you're one of the carriers.
You have touched on something very interesting that's been under a lot of debate. I mean, when the medical plan carriers were coming out with these plans, the question under ACA is like, well, there's the rules around, is the same contract? Is there interplay? Trying to really separate the medical plan from anything that's not being considered as qualified medical insurance from ACA standards. They really did try to separate the two, but that's a much longer discussion around whether or not some believe that it's not appropriate for the medical plan carriers number one, it's kind of moving shells behind the scenes, to your point. But the other side of that is, from a logical standpoint, if you have a medical plan carrier, you know what the medical plan claims are, and you can help to support, nudging or integration of claims. So, but I don't know that, from a legal standpoint and the spirit of ACA, many believe that there should be more of a separation of church and state, if you will, between the supplemental medical
But is
plan.
anyone, I mean, there are already different tiers of plans: high deductible, low deductible,
Mhm.
HSA, the list goes on, narrow network versus open network. Is there an opportunity for some of these carriers to just roll these supplemental benefits into a tier of plans? So it's all one package and I can buy the gold, silver, and bronze package, or they need to stay separate, supplemental versus core medical?
There are reasons related to ACA that they need to stay separate, from
Mhm.
a legal standpoint. But your concept, what you're talking about, is actually where my vision has always been. How can you have a supplemental plan coming from the medical side 20 years ago? How can you have a medical plan be supplemented by a supplemental health plan in a way that the two, like you literally have 1+1 = 5? And I
Mhm.
actually believe that can happen. We've got, a couple of studies going on with some of our clients to really look at that integration of how do we have, there's two that are sharing the cost, the employee and the employer. Disregard stop loss for a second. Is there a way to add a third party to that cost share equation, the supplemental health plan, so that you have to do the math, you've got to pull out
Mhm.
the actuaries, you've got to design, but the concept is that it absolutely can have an impact. And that's the future think stuff that I love to get into, and I probably need to get out more. But that's where if envision these plans all along. It's like we've created a model, which we'll talk about in a minute, that actually helps the employer. It's the closest to self-funding as you can get in the supplemental health plan, controlling where the dollars go.
Yeah.
But the second part of that is really, how do you integrate from a strategic standpoint, design and pricing? And it's not going to work for every employer, but how can you leverage the supplemental health plans to work in going in the same direction of a strategy to help lower the employer or employees cost and
Mhm.
actually lower exposure or even drive some behaviors? I'm getting way ahead of myself and I'm geeking out on you, but that's where I think these plans should live. But the requirement to get there from my chair is for the employer to have the control over the plans and visibility of the dollars, which they haven't had before. So that's why I think we're a step closer to getting to that vision, which could be very interesting strategies on the horizon that I know some employers are looking at.
So let's jump to employees first and talk about what you're doing. But again, just to kind of summarize the first part of this conversation, you've got the employer who has an incentive to offer these plans because they're now pushing more dollars to the employee. Plus, they need sort of a soft landing to offer their employees as that occurs. You've
Exactly.
got the employee who is, back to the first sort of part of this discussion, not necessarily making the most informed purchasing decisions about how they consume supplemental insurance. And you've got consultants that are incentivized to push these plans, and you've got carriers that are earning a lot of money and margin because the utilization of what gets purchased in this market is not necessarily that high. So you've got pretty diverse range of variables driving suboptimal outcomes, at least as characterized in this conversation. Where to begin? And that's a good segue to just understand what Employees First is doing, how you're attacking it. Are you looking to take on all those variables at once, or are there particular variables you're looking to solve for first?
I think we have to take it a step at a time. And I think it has to be in order. You have to solve some things first before you can solve the other. But I think the initial thing is what we talked about: the fact that these are the first thing I tried to do is convince HHS that open up the possibility, open up an approval for a self-funded supplemental health plan, because right now it's illegal. And the responses that we received were, it's a great idea. They understood the concept was to bring some transparency and, frankly, integrity to this business and allow for the design and the innovation to occur related to overarching healthcare trends and costs. But they'd have to go to Hill and change law, which that's
What,
not going
what
to.
incentive would an employer have to step into the self-insured supplemental benefits? I mean, part of the reason why employers are interested in self-insurance in the medical benefits is they, for whatever reason, they have taken a stake and an interest in paying for the premium dollars.
Well, Keep in mind that these aren't, even though they're medical plan payments, it's not like a medical plan where these are fixed benefits. So it's very consistent. So it's not
Mhm.
as risky from a self-funding standpoint. And most employers don't know that. They wouldn't take it on because they've got so many things that they need to do today anyway. And it's not that they'd be interested in it. The only thing that self-funding would avail is the transparency.
Mhm.
It really doesn't include a great deal of risk because these are fixed benefits, and with a large pool of numbers, you know what your claims are going to be. We purchased a couple of years of market scan data from Meritive. ICD-10s, how often does it happen? By age group, by age. So you know how often it's going to happen. It doesn't change, the numbers of events. The cost is not the issue. It's how often it occurs. That's what gives some stability to these plans. So it's not that they would be interested in doing it. It just wouldn't be a difficult thing to do to
Understood.
self-fund these. But they don't but you know what? They don't self-fund their dental and vision plans either. And they too would also be very easy. And so I think it's from an ease standpoint that they're not interested in doing it. The only reason I was interested in it is to break open,
Yep.
pull back the curtain, right? And that was the incentive I had to try to get something like that approved. Is
Understood.
that it opens back the curtain because there's so many dollars that were not going towards what the employer would have intended them to go towards, right? And so the model that we've created, and there's a couple out there, and I actually really do applaud. I wasn't the one to think of this because I didn't understand. We use a captive, and a captive is an insurance company, but it's not the employer's captive. It's an insurance. Basically, the model that we have created is as close to self-funding in that we have capped the carrier's fees,
Mhm.
basically like an ASO. And so there's no profit gain from a low loss ratio. That incentive needed to be removed.
Mhm.
So we've capped the carriers. And we've also monitor the claims themselves and do our own calculations of the real loss ratios. So after claims and expenses, and our expenses are baked into that we're adding expense to the equation, in fact, but we're lowering the larger expenses. So the net is much lower than what the employer is seeing as far as the cost of the plan. And then everything that's remaining after that are dollars that could be permissibly used within a wrap that go back to the employer's plan to be reinvested in benefits. So it's full circle. The dollars come in and they have to go back full circle back to the plan itself to benefit the employee population. So
So let's dissect that because I mean there's a lot there, and I want to make sure that I understand it. So let's just say the premium is $100, and let's say the average loss ratio is 10%, so $10 of actual expenditure against $100 of premiums. One of the things I heard that Employees First is doing is you're bringing transparency to clarify that the actual spend is $10 and not 50, not 80, not 90, not 100, but 10. The other thing that you mentioned there is you're capping the carrier fees. How does that work? So let's say again there's $90 of unspent premium. Does that 90 somehow get returned back to the the employee, or what happens to that 90 with the capped carrier structure?
So let me give you the contrast of the before and the after. I think that
Yeah.
may resonate a
Perfect.
little bit better. So the before, using that tip, we'll say 20% loss ratio.
Oh.
So the employee buys the policy, it's $100 a year. The premium goes to the carrier, they pay claims and they pay compensation, in the form of commissions. They pay tech credits. They fund a lot of different things. There's a lot of different labels to compensation. So most of it goes to compensation in some way, shape, or form, and whatever's remaining after the claims and their own internal expenses and the compensation is their profit. So there's the lever internally. So the lower loss ratio, in truth, benefits the rest of the rest of the dollars that are going to either compensation areas or to the carrier profit bottom line. That's the world today.
Mhm.
Excuse me. The new paradigm through our model is that let's first use the scenario of the claims being exactly the same, and then we'll do one more scenario. So say it's a 20% loss ratio. We cap the carrier and our fees. Typically, there's a range based on services in the model and when dollars are returned. I won't get into the details, but say 30%. All the plan expenses are capped at 30%. Any of the dollars after that 20 and the 30 would then be the employer could make a decision, I'm going to reduce the price of this. So the employee pays less. or I'm going to increase the benefits, which we did that substantially for one of our clients. We're going to pay more claims. And I take the crawl, walk, run to move that loss ratio up over time to just be a thoughtful approach, but they could pay for additional plans for that policy. Instead of paying $10,000 for a stroke or a heart attack, you get $20,000 as an example. Or you broaden, I'm going to pay for sepsis and COPD and all these different coverages. So you pay more claims. Or those dollars can be reinvested back into, there's some guardrails that the employer has to follow. They have to go to the benefit of the plan, capital P, but they are reinvested back into the plan. So those are the three choices that employers have. From the traditional, they move to the employee's first model. They have a choice: reinvest the dollars, lower the price tag, raise the plan value. And the fourth choice, the other option I was going to talk about, is actually just rate how it is that we've been able to effectively raise the plan value and customize based on our analytics of what's going to get the biggest bang for the buck for the employer based on demographics and the population.
Are those good numbers to use? 20% medical loss ratio, 30% in the pro forma scenario, 30% for the various overhead and fees?
So I would say that 20% was just mirroring the traditional plan. I would never say 20% loss ratio is a good loss ratio, but that's just mirroring like
When I say good, I mean, are those realistic numbers to use?
Unfortunately, more often than I even thought, being what was supposed to be the expert in this space, 20%, you're seeing still so many plans that are in the 20% range. And some are starting to go up, but you'll see from 20, once in a while, you'll see one in the 50s, but that's not very often because a loss ratio is claims and reserves. And if the carrier is assigning the reserves, they can basically say whatever the loss ratio is, whatever they want to point it at. So they'll say it's a 60% loss ratio, when in fact, when you look at the claims, it may be 30%.
Got it. So you got back to my question before when you said about this discrepancy on sort of the middle part of what you offer, which is the transparency and analytics. The reason why there's a discrepancy between your loss ratio and the carrier loss ratio is how much they're reserving for claims.
Exactly.
So what about if 30% is a good number to use for the fees pro forma, what is the fee structure before employees first gets involved?
Well, there's not an actual fee. It's basically whatever's left over is profit. And that's where we're seeing 50 and 60%,
Okay.
sitting with the carrier. And think about that in terms of medical claims. ACA requires that for medical claims, only 15% of the dollars can be used to administer. The 20%, that's actually pretty rich for plans. This is not full medical plan underwrite, claim payments are disparate. Critical illness, the occurrences are very low. The dollars are high for the payments. For accident, you'll see more claims, but very low claim utilization compared to a medical plan. So there's certainly the room for even that 30% to be dry. And I fully intend that. We needed to make sure that the carriers were a part of this. And actually, I'm defending the carriers to some extent here because I do know for a fact that they have been very much challenged with a pay to play from the consulting community. The higher compensation, then I'll place you. There's no other way to say it. And that's something that, is been a growing problem in the industry. So their margins have been shrinking because they've had to pay out more and more in compensation. And because that's the hand that feeds them, the consulting community. So I'm defending them to some extent in that I know that they have been pushed for higher and higher compensation. So even if they wanted to raise that loss ratio, they wouldn't be able to.
So give us a sense for some of your customers. How many customers do you have? Who are you working with? Are they large companies, small companies? How have those engagements gone?
So we have about, I'd say 65 million in premium under our belt. We work with large employers. So we don't have a ton of clients just because, you go slow at that level. But we range anywhere from, our largest client is 160,000. I think they're now 170,000 employees. And we've got another 100,000, and our smallest is about 7,000 employees. So that's the range of the employee population. The premium, you can usually look at an employer saying, to do a quick calculation, usually about $100 per benefit eligible is on average what the premium is for an employer if they were to launch a voluntary benefits program. So it's been the battle to obtain the clients truly has been the ecosystem, as I brought up, the consultants, I was naive with this, to be frank, Jason. I thought that if I built a model that could accommodate for the employer could choose the compensation that's going to go to their consultant if they could elect it. And there's 20 to 30%, level premium commissions that are baked into these plans. Some of them pay 70% in the first year. If the employer chose that, that's their choice as the fiduciary, the sponsor. And I built a model that would accommodate for the employer to make that decision. And I was naive in thinking that the brokers and the consulting community coming from that would welcome that with open arms, because it doesn't limit their compensation with some of the other models do.
Right.
And if they wanted to net compensation out of it, that would be the employer choice. Where I was naive is that the brokers are losing the control over the plan and their compensation stream, because the employer's now making the decision, and they have the line of sight of where the dollars are going. And they have the line of sight of, do they really need $1.2 million to do this service, when as a fiduciary, they need to make sure that fees are appropriate. And I think that the consulting community is understanding that I'm not going to be able to earn $1.2 million, but the employer today isn't paying as much attention to it.
Have you been able to bring down the successful, I guess the total utilization ratio or the loss ratio through in these engagements? And how does employees first get compensated throughout the process?
We bake our fee into that fixed cost. So we're an insurance company, so we have to have reserves as well. So it'll always be a percentage of the premium, but we bake our fee, and the goal is to keep it as low as possible so that more of the dollars can be distributed either back into the plan value or lower cost or reinvestment. But we cap ourselves as well, just like we did cap the
Do
carrier.
the employers working with you get sort of an itemized list of, here's the money going out and exactly this is how much is spent for claim payment of claims, this is how much is spent on reserves or reserve for reserves, this is how much goes to each consultant and IT costs and things of that nature?
They get every penny reported, and they have it's a dashboard where they actually see literally where the projections were and where the dollars are going. And then they get to make the decision because usually when you have compensation that's baked into a policy, that compensation is locked in for the life of the policy.
Yeah.
The way we have it set it up, they could still have this, and as they should, they need their consultants. I used to be one, I know this. But it's about the fact that they have control over how much they're going to get and how much they're going to get every year. As an example, one of our clients, they started the program at $8 million annual spend on it, but now they're at 25 million. Yeah. So if you have 25% of that and at 8 million, that's a very different number than 25% of 25 million. So the employer doesn't have control over modifying, without,
It reminds me a bit, we had Mark Cuban on. Mark is Mark Cuban, but he's the CEO now of Cost Plus Drugs. And so he brought transparency and is aiming to bring transparency to drug pricing through a cost plus model. And in some ways, although this is not necessarily cost plus, but you have a similar goal of bringing transparency to an otherwise opaque space. I have two more questions. The first is pushback. I know the consultants you mentioned have sort of vested interest, and so I get that pushback, but I'm sure that you faced other forms of pushback. There's risk working with a smaller captive versus going with some other incumbent solution. The lower reserve calculation, I know that it's, the claims data shows that it's very forecastable, but lower reserves equals higher risk and is not feasible over the long term, is not sustainable. What are the common points of pushback that you get from the stakeholders, which are, for me, the employer and the carrier, not so much the consultant? And what are your responses to those common points of pushback?
Well, from the employer's perspective, obviously, they're the ones that it's their plan, they're the fiduciary, they have to make sure it's buttoned up, right? And coming from the large market space, we did a lot of baking before we even launched, knowing that would be the case. So we did things like we got opinion papers for, from law firms like Groom, and they're typically the firm that employers will go to when they're trying to get a prohibitive transaction for their own captive. So they're very knowledgeable in this space. So getting opinion letter, we literally went to 7 of the tier 1 law firms and had them beat up our contractual structure and we made changes along the way. So we did a lot of the pre-work. And frankly, I really thought that the contract process would be the longest thing longest part of our adopt a program, it's been a phone call.
Yeah.
I've been blown away. So that's been the shortest, but it's overcoming two things from the employer's perspective. They have more to do today than they ever have. And I see that firsthand, and having the bandwidth to even look at it when their consultant may not be on board with it. So it's the risk factor with that. And then just the fact that it's something that's new. But in reality, there's nothing new under the sun. Captives have had benefits in them for over 25 years. The carrier still does all of the work. We've really tried to minimize any type of disruption for the employer. They can keep the same carrier. They can keep their same consult. They can keep their no changes to that. It's just a matter of examining the program. But this is the time, as you know, it's been really difficult for employers to pay attention to anything. And it's something that's new. So that's
because I would imagine, I mean, pro forma, you've got happy employees. So they're either getting money returned to them or they're getting higher benefits. But until you solve for whether, it's bringing the employers into the self-funded voluntary benefit space or something like that, the employers have limited skin in the game. So it's not the employer that's necessarily gaining tomorrow versus today.
They actually, what I've experienced, Jason, is that it's not a winnable argument. It's a win-win-win all the way around. It truly is. It's the understanding that there is no real risk in this program compared to what they had. There's actually greater risk today with transparency and class action lawsuits because this is a huge target. The proportional risk of looking at inflated fees compared to the 401k, looking at the fees in this, it's a slam dunk for the legal community to class action lawsuit because that's where we believe the bigger risk for employers is not knowing and having it in that's not going to be the excuse for them. It's like, well, I didn't realize that they didn't care on 401k, and that's going to be the same thing.
A lower risk profile for employers.
It's a lower risk program. We've even talked to some of the tier one ERISA law firms, and they're bringing us into their clients because they see this as a way to mitigate that risk because every dollar is exposed. They're assured of the appropriate amount of fees. They see it firsthand. And so that's a way to mitigate.
Have you seen any movement on class action lawsuits or other types of lawsuits that are going after employers for these fees, or is that more of a prospective look of what could happen?
Unfortunately, it's not prospective. I know that the law firm that was really renowned for the class action lawsuits for 401k for excessive fees, I know for a fact that they are looking into these plans. And this is the thing that, I've had, well, Amy, you should go talk to them and tell them, because obviously I'm the wizard behind the curtain. The problem is the employer is the one that's going to pay the price. They're going to one and they don't necessarily understand what's going on behind that curtain. Mm-hmm. And that's the problems. Our goal is to get in front of that for employers and just to educate them, make sure that they understand what their options are and then make an informed choice, but which is not a luxury that they have right now, because we do see this is going to be a brush fire because as soon as they're already on the path at looking at it, we know that they've got an active investigation going on right now.
One final question. We won't have time to do it justice, but we'll do it in sort of short form. So we've covered voluntary benefits, and I want to take the key sort of takeaways from this conversation and see if any apply to the medical benefits. So one of the themes of this conversation has been employer not necessarily having skin in the game on the plans and the underwriting. I would say that doesn't sound like it really crosses over to medical, because I think you in many cases have both, but you at least have one of paying a large portion of the premium.
I would agree with that.
Another is low utilization of the plan. I would say that probably doesn't carry over to the medical side either.
Not at all. I think the only correlation you would see is obviously there's some inefficiency in the healthcare delivery system, as we all know.
Sure.
And people like Mark Cuban, they're picking that apart in a good way. It's a different kind of efficiency that's really, and actually it's tougher to get at in truth. And that's why, my concern around the class action lawsuits is greater because it's easy to pick at this, where it's going to be harder to get your teeth sunk into a case. So that's why we think the risk is there.
Well, what about the other two things I heard that may have some carryover and they may not? One is the sort of playing around with, or maybe that's too biased, the reserve disparity in reserve counts, calculations, and the administrative fees as part of the plan, and then also the high commission rates. How much of that carries over to what we see in the medical space, if any?
So I don't see that in the reserve calculations because if it's fully insured, you don't have reserves. I mean, I'll leave that one at a high level because obviously, even if you're self-funding, you have to have dollars sitting and waiting to pay the claims, but it's not the same as insurance reserves. So I don't see the correlation with that. I think that the inflated fee components, that is absolutely relative, especially in PBMs and especially in the pharmacy. There's the hidden inflated fees. I think that there's definite correlation to that, a different way to get at that than what we have done, for the employees first in our model. But that is a concurrent theme around fleet fees being inflated that have profit margins in there that aren't reasonable. Again, nobody's arguing with profit.
Yeah.
Everybody understands that. It's the unreasonable profit, and it's the profit margins that's not being, and this is where I bring emotion to this, that isn't even being disclosed. The employer, as the plan fiduciary, they don't know it. That's the part where they can't have any control over something that they don't know or that it's really hard to get at. And I see that as a definite
So it
correlation.
sounds like, really, notwithstanding some inefficiencies or questions on what is the right profit level, it sounds like the medical side really is a much more efficient market for the reasons we've talked
It
about.
is. I think it's a much more efficient market. I mean, they moved from fully insured to self-funded to become more efficient, to have more control, and they can examine the point solution fees. So there's a lot more efficiency into it. It's just a much bigger bucket, much bigger dollar, and a lot of other places to hide in the many point solutions that are brought to bear to help control or manage, healthcare costs and claims and expenses.
Amy, I really want to thank you for your time. I know, a big part of Employees First is about educating the market on this market and its inefficiencies, and then how Employees First can help. And you've certainly, done a service to me and hopefully to our listeners, providing insight into the voluntary benefits market, which is a space that I coming into this conversation really didn't know a whole lot about. So I really appreciate it. And I wish you luck with what you're looking to develop at Employees First.
Well, and thank you for having me. I'm grateful to be here and appreciate your interest in it.
Thank you so much. Take care.
Thanks.